Welcome to the SCR Home Financing Podcast, where we believe a legacy is something you build, not just something you leave behind. And now, here's your host, Jeff Chisum.
Hey, this is Jeff Chisum with STR Home Financing. Hope you are doing well. Welcome to episode 50. Cannot believe we've made it this far, but here we are. Hopefully you have found value in the content, the education, and it's put you in a position where you can take action. So last week's episode, we revisited DSCR loans. And so this episode, I really wanted to cover what are some good questions you need to be asking a prospective lender when shopping for a DSCR loan. So number one is, should you be shopping for a DSCR loan? This is 100% of my business, is helping clients with the financing to buy in the short-term rental asset class. About 90% of my clients are using the 10% down second home occupancy loan. So those are people that typically are W-2 wage earners, so they have to report all of their income, Fannie Mae, Freddie Mac, which are the underwriting standards, the golden rule when it comes to conventional financing, which that 10% down second home occupancy loan is. They love W-2 income. So that is the typical scenario. There are self-employed clients that do qualify for that product. And our application process, we have one application for all products. We'll typically, if a client is worth or willing to go through the work of sending in documents, have them fill out the application, send in documents, let us analyze everything to see if it's there. Because typically people love that minimum down payment of 10%. The second home occupancy loan is going to give the lowest of the interest rates out of all the products outside of a primary residence. So typically it's the product for those that qualify that makes the most sense. So who should be shopping for a DSCR loan? That's typically someone who you really want to speed up your scaling, and you've maybe bought 2 or 3, you've maxed out your debt to income ratio, and you need something like the DSCR loan that isn't going to take a debt to income ratio into consideration. Maybe you are that self-employed borrower who writes off everything that the law allows, and you just don't qualify for that traditional financing. If 90% of our business is the 10% down second home occupancy loan, really the rest of our business is that DSCR loan. And really the reason why it's not an investment property loan through like Fannie Mae, Freddie Mac, is because of the additional fees that have been imposed on that product. And it really raised the rates, raised the fees on that product. So even though you can use the rental income to 70% of the projected rental income on a conventional investment property loan, and maybe you qualify for that, it's just not making sense right now. DSCR loan's been a great option because those investors out there, they have not waned from their appetite to do this product. So the rates are competitive. It's a competitive rate environment for those investors wanting to do those deals. So it's just been a more attractive option to do the DSCR loan than a conventional investment property. So hopefully that information kind of clarifies some things that you may be seeing out there. This episode, we want to cover questions that you want to ask a lender so that you're not blindsided during the process. So the number one, the obvious is, what are your rates, your costs, your fees, and minimum down payment? And you're going to see a range of those, and you want to know what goes into that. So you may have a company that quotes a low rate, but they have high fees, or they require more down, or they require a higher coverage ratio. Just things that you want to ask. If you see something that you've heard higher rates and someone's quoting a lower one, you want to ask that question: how are you able to offer that? What goes into that? What am I going to have to give in order to get that lower interest rate? So number two, what ratios are you looking for? Is it a 1-to-1 ratio? Can it be below? Can it be cash flow negative? Are you looking at something higher than a 1-to-1 ratio? So you want to be clear on that. Number three is, what data do you use to prove the ratio? Now, this is where experience comes into play, and we're going to get into another question here in just a minute. I'll go ahead and throw it out. you're going to want to ask them, how many DSCR loans have you originated in the past year? It's like asking someone who's about to operate on you, how many times have you done this operation? Because you don't want a rookie. You want someone who has had experience so they know if there's something that happens out of the ordinary, that they've seen it or they know how to deal with it or they can address it up front versus, again, you getting blindsided by something because of their inexperience. It could kill a deal. It could cost you money. But with that, that question of what data do you use? We've been working with an investor, same investor for the past 3 years. We average about 3 DSCRs a month, sometimes more, sometimes less, but on average about 3 for the past 3 years. So we've seen a lot of things, but the most important thing is we've had that consistency of working with that same investor. We know what they require, we know what their appetite is, we know what they will allow. So when we are pre-approving someone, we find out where they're looking, we look at that data, we know from past experience whether it's going to be favorable for an approval, or if we can say it's marginal, or we can tell someone you're really going to want to look in a different market area. So that experience matters, but there's different sources of data. So it could be it's an existing STR where the seller is willing and able to provide 12 months of financials to show cash flow. What if the property that you're looking at has never been an STR? That's okay. There's other sources of data that can be typically used. One is from the appraiser. So we order an appraisal where we request the rental comps. And what we're seeing and what we have seen over the past few years is, especially in destination areas where short-term rentals are prevalent, is they can get their hands on the short-term rental data. So instead of providing long-term rental data that's going to show typically a lower cash flow amount, they're getting the short-term rental data. And when they can, we're blowing that 1-to-1 ratio out of the water. So it makes it very easy. Now, in the case of our investor, we know that on an exception basis, they have on a regular basis, consistent basis, approved AirDNA data or data. It could be other sources, STR Insights, Rabu, similar data that we can submit that data to them to prove the ratios. So that's where it helps, knowing that we've had a good track record of being able to use that data when we're advising someone that in that pre-approval stage prior to contract on the favorability of a pre-approval. So yeah, can you use STR data is an excellent question to ask, because some originators can only use long-term rental data. And I'll go back to the experience piece. When it comes to rates, down payments, and your shopping, you may come across a broker. Brokers have their place, definitely. But when they're dealing with multiple investors, it can be a moving target as far as what that investor has an appetite for on that day. Or they may not be as experienced with that investor. They just have a really attractive rate. Let's go with that one. But they're not experienced, or they don't know what that investor is looking for to get an approval, and that approval leading to a closed loan. So beware of the trap that a low interest rate can bring. So number 5, it's very similar. Are you delegated with the investor, or will the investor be processing, underwriting, ordering appraisal, closing, and funding the loan? So delegated means, which we are with our investor, that we keep control of the entire process. So we process the loan, we underwrite the loan, we order the appraisal, we give the clear to close, we close the loan. So we work with the title company to draw up closing documents, and we fund the loans. That's a lot of steps, a lot of areas where there could be hiccups if you lose control of the process. So there's a lot of brokers, there's a lot of independent mortgage companies where they're not delegated or they're brokering that out to an investor. They lose control of the process, and that can be a issue when it comes to the timing. So every time they get something in, or the appraisal comes in, or they need something reviewed, they have to send it to the investor for them to review, or they have to wait for them to order the appraisal, or they have to wait for them to issue the clear to close. Each step of that way takes time. You build in enough of those steps where it has to go back and forth, it can delay closing. that can get you in trouble. So another thing that you want to be aware of when you are interviewing, you definitely don't want to find that out after you're under contract. The other question is, do you lock up front? So a lot of companies will not lock up front for various reasons. They're hedging, whatever. They don't want to be caught locking a rate in, rates go up, and then they lose money. So they'll wait to lock the loan until maybe when the appraisal comes in, or until the clear to close is issued, or 5 days before closing. And then you find out rates have gone up, or just so many things that can go into that, where what was talked about up front changes once you get to that point of locking the rate. So very important to ask that question, do you lock the rate up front? Number 7, what can change the rate, my cost, or the required down payment from beginning to end? So again, there's a lot of variables that can go into what can affect the interest rate, what can affect your closing cost if they're not locking up front. So let's say the rent comps come in, it doesn't show as strong as what you had anticipated or what you had discussed with the loan officer. Now they're telling you the appraisal's showing this or the appraisal's showing that. We found out about this. Now your rate's going to go up. You're going to be required to put more of a down payment. There's going to be additional fees. Just all of those things that no one wants to be blindsided with once they're under contract. So I hope this helps. Always happy to jump on a phone call. If you'll go to my website, strhomefinancing.com, you can see a link there to schedule a call with me. If you would like a list of these questions, look in the show notes. Hope this helps. Until next time.
Jeff Chisum is a registered mortgage loan officer with CMG Home Loans, NMLS ID 1820. CMG Home Loans is an equal housing lender. All programs, products, and terms discussed on this show are subject to change without notice.